You know that feeling when you're standing in the checkout line at Target, staring at the card reader, and you're doing that little mental calculation in your head? Okay, groceries were about $120. Gas was $58. Rent already cleared. Credit cards due on Friday. This should be fine, right? And it goes through. But instead of relief, there's this weird tightness in your chest. Because it was a completely normal month. Nothing crazy, no trips, no emergencies, just regular life in America in the 2020s. And somehow, again, there's less money than there should be. Then your brain spirals. Am I missing something? Am I behind? Are other people secretly doing way better than me? And honestly, that spiral makes sense. That can definitely happen when the numbers stop lining up with the effort you're putting in. Here's the part nobody tells you. It's not that you're irresponsible. It's not that you need to budget harder. It's that the math quietly changed and nobody updated the rules you were told to follow. Welcome to Ben's Money Milestones, where late starters build real wealth. And look, just quickly before we go any further, let's be clear about what we're actually talking about today. This isn't a motivational video. This isn't a stop buying coffee lecture. This is about understanding why so many smart, disciplined people feel broke even when they're doing everything right, and why that feeling isn't random. Because once you see the pattern, a lot of the shame drops away. Let's start with something uncomfortable but important. Most people are measuring the wrong kind of success. We've been trained to chase net worth, big numbers on statements, home values, retirement balances. And on paper, you might be actually doing okay. Maybe even better than average. Your house appreciated, your 401k crossed six figures, you're ahead of where your parents were at your age, technically speaking. But here's the thing. You can't pay for a car repair with your kitchen. You can't take a career break with your roof. You can't fund an emergency with money locked inside a 401k without penalties, taxes, and stress. You can't use your home equity to cover next month's daycare bill. What a lot of Americans have today is trapped wealth, equity rich but option poor. And that lack of liquidity is what creates that constant low-level panic in the background of your life. You might be worth $500,000 on a spreadsheet, but you're running paycheck to paycheck in reality, and that disconnect is maddening. This is where the Millionaire Mirage comes in. You've probably seen the headlines. America has over 24 million millionaires. Sounds reassuring, right? Like, okay, maybe the system still works. But most of those millionaires only hit that number because of home equity and retirement accounts, money they can't actually deploy. When you strip out the house someone lives in, not an investment property, just shelter, the number of people with real investable assets collapses. Suddenly, the club gets very small. So on paper, people look wealthy. In real life, they're fragile. And confusing asset inflation with financial freedom is one of the biggest psychological traps of modern money, because rising home values don't give you options. They give you higher taxes, higher insurance, and pressure to spend like someone who's actually liquid. Your neighbor sees your house is worth $650,000 now and assumes you're rolling in money, but you're still sweating over a $1,200 emergency vet bill. And here's where it quietly gets worse. As people feel richer on paper, they take on bigger fixed costs, nicer homes, more expensive cars, lifestyle upgrades that lock them into higher monthly obligations. So even though the balance sheet looks stronger, the margin disappears. You're worth more and feel broker at the same time. Now let's talk about one of the biggest structural shifts behind all of this, the two-income trap. In 1970, the median home cost about 2.4 times the median income. One paycheck could realistically support a household. There was slack in the system, a cushion. If something went wrong, the family had options. Today, that ratio is often 5.5 to 6 times household income, and that's with two people working full-time. What happened wasn't greed, it was a competition. When dual incomes became normal, families used that second paycheck to bid against each other for the same things: good schools, safe neighborhoods, shorter commutes. Prices rose to absorb the extra income. The market didn't care that you were working twice as hard, it just saw more buying power and adjusted accordingly. And now, two incomes aren't extra, they're required. Here's why that matters psychologically. The second income used to be the backup plan. Now, it's the baseline, which means if one income goes away, layoffs, illness, burnout, childcare issues, the whole structure wobbles immediately. There's no buffer, no margin, no room to breathe. You're running at 100% capacity just to maintain normal. Let me give you a real-world picture. Meet Daniel and Priya, mid-30s, one kid, living outside Raleigh. Combined income about $108,000. That's solid by any reasonable definition. They're doing better than the median household. They should feel secure, right? After taxes and benefits, they bring home roughly $6,400 a month. Their mortgage, taxes, insurance, and HOA come to $2,450. Childcare is $1,100. Two cars, insurance, gas, maintenance, around $850. Utilities, phones, groceries, internet, another $1,500. They're already over $5,800 before saving, before emergencies, before anything unexpected, before retirement contributions, before the small stuff that always comes up. They're not living extravagantly, they're living normally. And that's the problem. Normal is expensive. Normal is fragile. Normal leaves almost nothing left over. Because while you're juggling all this, financial advice is yelling at you about lattes. This is what I call financial advice gaslighting. You're taught to obsess over rounding errors, coffee, streaming subscriptions, protein powder, the $12 salad at lunch. Meanwhile, 5 major decisions determine your financial future: housing, transportation, healthcare, kids, and lifestyle inflation. And nobody spends proportional time on them. You'll spend 30 minutes debating a $40 dinner, but maybe 15 minutes deciding on a mortgage based on what the bank approved you for. And let's be honest about incentives. The bank makes more money the more you borrow. Your incentive should be the opposite. Those goals are not aligned. The person across the desk isn't your financial advisor. They're a salesperson with a quota. Car payments are a perfect example. The average new car payment in America is around $700 a month. That feels normal now. Dealerships stretch loans to 72 months, 84 months, just to make that monthly number feel manageable. But over a working lifetime, that single decision can quietly cost over $1 million in lost compound growth. If you took that $700 and invested it instead, month after month, year after year, you'd retire with an entirely different life. That's not a discipline failure. That's a system designed to normalize long-term extraction. You're being sold normally, and normal is a trap. And all of this is happening in an environment of constant comparison. Financial theater is everywhere. The quietly broke professional with the newest iPhone, the neighbor with the luxury SUV, Instagram vacations that look effortless, the coworker who just renovated their kitchen. And you start thinking, how are they affording this? What do they know that I don't? But here's a stat most people don't realize. Roughly 1/3 of households earning over $200,000 a year have less than $10,000 in liquid savings. High income doesn't equal safety. It often just means higher obligations: bigger mortgage, private school, luxury car leases, country club memberships. The pressure to keep up appearances at that income level is intense. This is the illusion of affluence, looking successful while being one disruption away from stress. And it's exhausting because you're performing stability while privately feeling anxious. You're maintaining the image while the foundation is shaking. Now zoom out even further, because this isn't just personal finance. The macro environment changed. We're living in a world with fragile supply chains, higher input costs, and asset-driven inflation. Housing, healthcare, education, the core expenses of middle-class life have risen faster than wages for decades. College tuition has increased over 170% since the 1980s. Healthcare costs have tripled. Housing in desirable areas has gone parabolic. Here's what that actually looks like in numbers. In 1985, the average worker could buy a median-priced home with about 3.5 years of their salary. Today, in many markets, that's closer to 8 or 9 years. Health insurance that used to cost a few $100s a year now runs families $15,000 to $20,000 in premiums alone before deductibles. A college degree that costs $15,000 total now costs $150,000 or more. Your parents played a game where productivity gains flowed to workers. You're playing one where they flow to assets. Companies got more efficient, but workers didn't see the benefit. Shareholders did. Real estate owners did. If you owned things, you won. If you only sold your labor, you fell behind. And most advice hasn't caught up. The strategies your parents used don't work the same way anymore because the game board changed. Saving 10% used to be enough. Now it barely moves the needle. This is why the same right behaviors feel weaker, why saving feels harder, why progress feels slower. You're working just as hard, maybe harder, but the treadmill speed increased and nobody told you. And if you don't have a buffer, you also pay what's called the poverty penalty, even with a decent income. Overdraft fees, high APR credit cards, inability to buy in bulk, higher insurance premiums because one missed payment knocked your credit score down. Paying more for literally everything because you can't afford the upfront cost of the cheaper option. Financial stress literally reduces cognitive capacity by the equivalent of about 10 to 13 IQ points, which means it's not just emotionally harder to plan, it's physically harder. Your brain is constantly running background calculations, threat assessment, contingency planning. That mental load is real. It affects your sleep, your relationships, your ability to focus at work. That's why this feels so overwhelming. Your brain is under load. You're not imagining it. So when people ask, why do I feel like I'm failing? The honest answer is this. You're following the normal script, and normal is broken. Normal means being house poor. Normal means carrying car payments indefinitely. Normal means selling your future labor cheaply to financial institutions. Normal means optimizing for appearance instead of resilience. Normal means living at the edge of your means because that's what everyone else is doing. And this is where we finally talk about what actually changes things. Not hype, not hacks, just reality. Liquidity. There's a reason the $20,000 liquid savings milestone matters so much. Not invested, not locked up, just accessible. Cash you can touch without penalties, without selling anything, without asking permission. Below this line, decisions are fear-based. You stay in jobs you hate, you avoid risks that could improve your life. Every surprise feels dangerous. A minor car accident becomes a major crisis. A good opportunity that requires relocation becomes impossible to consider. You're constantly negotiating with yourself about what you can and can't afford to do. Above it, something shifts. You can wait. You can say no. You can absorb a hit without panic. You can take a career risk. You can walk away from a toxic situation. You're playing offense instead of defense. You can negotiate from a position of strength. When your boss knows you're not desperate, the entire dynamic changes. When a car salesman senses you can walk away, suddenly better deals appear. This isn't about flexing. It's about behavior. Money stops controlling every decision, and that psychological shift is worth more than the dollar amount itself. You sleep differently. You think differently. You move through the world differently. Your shoulders drop. Your jaw unclenches. The constant background hum of anxiety fades to something manageable. Studies show that people with just 3 months of expenses saved report significantly higher life satisfaction than those without, regardless of their total net worth. It's not about being rich. It's about breathing room, about options, about not being cornered. And this is where stealth wealth comes in. Driving the paid-off car, living in a modest place, letting other people perform success while you quietly build resilience. Because real freedom isn't a net worth number. It's being able to answer this honestly. If my income paused for 12 months, would my life collapse? That's the line that matters, not what your house is worth, not what your retirement account says. Can you survive a shock? Can you take advantage of an opportunity? Can you say no to something that doesn't serve you? That's wealth. So let's wrap this up. You're not broken. You're not lazy. You're not bad with money. You're navigating a system that quietly changed the rules and then blamed you for not keeping up. And once you see that, the shame starts to fade. The panic softens, and you can start making decisions grounded in reality instead of cultural pressure. You can stop comparing your behind the scenes to everyone else's highlight reel. The path forward isn't sexy.
It's not about crypto wins or side hustles that make six figures. It's about ruthlessly auditing the big five expenses. It's about refusing to finance depreciating assets. It's about building liquidity before chasing returns. It's about letting your neighbor think you're doing worse than you are while you're actually building something real. At the end of the day, real wealth isn't about finding the next hot investment. It's about removing the chains, plugging the leaks, letting compound interest work for you instead of against you. It's about making invisible progress while everyone else is making visible purchases. And here's what nobody tells you about that journey. The first $20,000 feels impossible. The second $20,000 comes faster, not because you're earning more necessarily, but because you've built the systems, you've closed the leaks, you've stopped renting your future self's freedom to banks and car companies. You've stopped optimizing for appearance and started optimizing for options. Here's the uncomfortable truth. What you've seen in this video isn't the worst case. It's average. And average is exactly why so many people feel stuck even when they're doing everything right. But once you understand this milestone, you start seeing the next one. The point where money stops controlling your decisions and you start controlling it. That shift happens sooner than most people think. We'll talk about that next.